Imagine watching 4 trillion rupees.
Wow.
Yeah, 4 lakh crore just pack its bags and literally walk out of your country's economy in the span of like 24 months.
It's just a staggering amount of money.
Right. And today we aren't looking at some, polite economic forecast or just a sterile reading of GDP figures.
Not at all.
We are looking at a scorching critique of exactly how that massive capital flight happened and the alleged policy arrogance that basically let it slip away. So welcome to today's deep dive.
Glad to be here.
We are dissecting a super viral piece of commentary. It's by author Anil Akvev. It was originally shared on Facebook, published on Right.s, and It's titled Indian Economic Developments and Events.
And I mean, it is a blistering text.
Oh, absolutely.
The author doesn't just question the numbers, right? They question the competence, the motives, and really the foundational integrity of the current economic stewardship in India.
Yeah.
But before we even unpack these arguments, we need to make our position super clear to you, the listener.
Yes, very important.
This source material contains highly politically charged critiques of India's finance ministry and its financial regulators.
Right. And we are acting purely as your guides today. We're definitely not endorsing these views, nor are we dismissing them.
Exactly.
Our mission is just to translate this specific, really intense perspective so you can kind of see the mechanics of the author's argument.
Yeah, we want to look at why they believe enormous amounts of foreign capital are just fleeing India.
Right, starting with what they claim is a huge scandal at the very top of the regulatory ladder, and then how that trickles down to just, structural economic mismanagement.
So the author builds their case not by starting with, abstract macroeconomic theory.
Thankfully.
Right. They start with a narrative of broken trust. They go straight for the regulatory body that's tasked with keeping the Indian stock markets fair, which is SEBI, the Securities and Exchange Board of India.
Right. So for you listening, SEBI is basically the supreme referee of the market. They're the ones who are supposed to ensure nobody's cheating, that companies are transparent, and investors are protected.
Exactly. But the text alleges a severe crisis of leadership here.
Yeah, it gets pretty intense.
The author claims that the person appointed as chairperson of SEBI was just deeply unqualified, and that she secured this incredibly powerful position simply because she was and I'm quoting here, dear friend of someone in power.
Wow. And they point to her past, right?
Yeah, they specifically point to her past tenure at ICICI Securities. The author claims she was actually ousted from that position, only to eventually fail upward into the chairperson seat at SEBI.
Fail upward into being the top market referee. That's a bold claim.
It is, but the critique goes far beyond just nepotism.
Okay, so what else?
The author uses this appointment to paint a picture of, systemic cronyism. They detail how it took an actual whistleblower to reveal massive, completely undisclosed conflicts of interest.
Oh, right. This is where it gets really complicated. The text alleges that this chairperson held investments in the Adani Group, which is a huge conglomerate that's obviously faced its own intense international scrutiny.
To say the least, yeah.
And on top of that, her husband serves as an advisory member at Blackstone,
one of the world's largest private equity firms.
Right.
I mean, think about the structural implications of those ties.
Yeah.
You have the regulator overseeing the market, and they have direct financial links to the major players operating within that very market.
It's crazy.
The author argues this is just a fundamental breach of corporate governance. It basically set a fire in the market, and according to the text, this fire's been burning for 3 years.
Okay, wait, I have to push back here for a second.
Sure.
4 trillion rupees is a staggering amount of money.
Yeah, it is.
So surely a single bat enough to trigger a capital flight of that magnitude, right? I mean, is the author suggesting one person broke the entire market?
Well, the author is suggesting that this one appointment broke the mechanism of trust.
Ah, okay.
And trust is literally the only thing holding a market together. Imagine you're playing in a high-stakes poker tournament.
Okay, I'm with you.
And you suddenly find out the dealer is secretly staking one of the players at the table.
Oh, wow. Yeah.
And not only that, their spouse is advising the casino.
I would question every single hand dealt. I'd grab my chips and run.
Exactly. You wouldn't stay at that table. When the foundation of your financial regulatory system is compromised by perceived cronyism, the entire market becomes suspect to an outsider.
Right, because foreign investors price risk into their models.
Precisely. If they believe the referee is compromised, the risk premium goes way up. And if the potential returns don't match that new massive risk, they just pull their capital. You really can't separate the integrity of the regulator from the confidence of the investor.
So the high rollers look at the compromised referee, pack up their chips, and leave.
Exactly.
Which brings us to those players at the table, right? The foreign investors.
Yeah, the author spends a significant amount of time focusing on FPIs and FIIs.
Let's clarify those mechanics for a second, just so we're all on the same page.
Sure. So foreign portfolio investment, or FPI, generally refers to foreign entities buying financial assets like stocks and bonds in the Indian market.
Okay.
They're relatively liquid.
Yeah.
Now, they can enter and exit pretty quickly.
Right. And then the FIIs.
Foreign institutional investment, or FII, involves massive institutional funds. We're talking pension funds, mutual funds, big insurance companies from abroad deploying capital on just a massive scale.
And both of these are absolutely crucial for providing liquidity to an emerging market.
Exactly. They're the lifeblood.
But according to the text, there was this bizarre psychological blind spot within the domestic political narrative when these foreign funds started getting, restless.
Yeah, it's a fascinating observation.
The author notes that initially, the public was sold this illusion that placing FPI and FII equity positions under strict local domestic control was actually an act of extreme patriotism.
Like, we are taking back our markets from foreign influence.
Exactly. It was framed as a sovereignty win.
But the author argues that anyone with even a basic grasp of macroeconomics recognize this as a super dangerous miscalculation of leverage.
Because it's not actually a win if the money just leaves.
Right. The text points out this delusion of grandeur among domestic actors. The author actually uses the phrase that some people think we are, quote, divine beings.
Divine beings. Wow.
Yeah. The implication is that domestic policymakers somehow believe the Indian market was so inherently special that foreign money was just a captive audience.
That global capital had to stay no matter how opaque or complicated the rules became.
Exactly.
Here's where it gets really interesting for you, the listener. Let's say you invest your hard-earned savings into a neighborhood business, right?
Okay.
And suddenly, the management starts making totally erratic decisions. They're changing the rules every single day.
Yeah, that would be stressful.
You wouldn't keep your money there out of neighborhood loyalty. You'd pull it out and move it to a different business down the street.
Right.
And the author's basically saying foreign investors aren't captive audience members either. They have roughly 200 other countries to choose from. So, is the author implying the finance ministry completely missed the global context here?
100%. The author argues that capital is entirely unsentimental.
It doesn't have feelings.
No. Global institutional investors managing billions of dollars do not care about a host country's internal patriotic narratives. They just don't.
Yeah, they care about math.
They care about transparency, stability, and returns. And the text heavily criticizes the Central Finance Ministry for an absolute failure to account for this reality, especially during global economic uncertainty.
The author mentions we are currently in a war environment, right?
Yes, that's a reference to the broader geopolitical instability we're seeing. And the author actually quips that this need for stability is something even children know about.
Ouch. So because of this failure to read the global room, the exodus began.
Yeah.
Over just 2 years, foreign investors sold off 4 lakh crore rupees worth of investments. 4 trillion rupees.
It's hard to even conceptualize.
Let's talk about what a liquidity drain of that magnitude actually does to a country. Because for you listening, it's not just a number on a spreadsheet, this.
Far from it. When 4 trillion rupees just vanishes, the immediate effect is plunging asset prices.
Because everyone's selling.
Right. There is simply less money available to buy local stocks, which obviously hurts domestic investors. But more deeply, it spikes borrowing costs.
Ah, okay. How so?
Well, when foreign capital dries up, local businesses find it much harder and way more expensive to raise the money they need to, say, build new factories, fund research, or hire people.
So it's not just finance bros losing money, it's jobs.
Exactly. It acts as a total chokehold on real economic growth.
Okay, so you have a compromised referee at SEBI, and you have global investors realizing they aren't a captive audience. But what was the actual systemic trigger?
The policies themselves.
Right. What were the specific rules being changed that drove that 4 trillion away? The author unleashes a barrage of critiques against the finance ministry itself, right?
Yeah. And they use the term sakananka, which seems to be a very pointed critique of the leadership there.
Okay, so what did Sakananka do to scare everyone off?
The author provides a really comprehensive list of grievances that basically acts as a masterclass in how to scare away capital.
Let's hear it.
First, they point to a heavy, unmitigated reliance on oil, which leaves the economy incredibly vulnerable to external price shocks.
Right, but that's tough for any emerging market.
True, but the critique really sharpens when it attacks the regulatory environment. Specifically, they highlight punishing retrospective taxes.
Okay, retrospective taxation is one of those concepts that sounds super dull until it happens to you.
Oh, it's a nightmare.
For you listening, it's basically the government changing the tax law today, but applying it to the money you made 5 years ago.
Yeah, exactly.
It's like playing a game, winning fair and square, and then the organizers change the rules retroactively to say you actually owe them points. It makes risk modeling completely impossible for an investor.
It destroys the predictability of the legal framework. If a foreign institutional investor cannot predict their tax liability, they cannot justify the investment to their board back home. They just can't.
Right.
But the author goes even further, claiming there is a total lack of true inflation calculations and a blatant ignorance of fundamental economic concepts.
Like what?
Specifically, currency indexation.
Oh, I love indexation. I want to use an analogy here because indexation is so crucial to understand this critique.
Go for it.
Imagine you are running on a treadmill. You are running faster and faster, putting in all this effort, but you are staying in the exact same place in the room.
Right.
That's inflation eating away at your purchasing power. Now, imagine the government comes along and taxes you on the quote-unquote distance you supposedly ran on that treadmill, even though you haven't moved an inch forward in reality.
That's a brutal way to put it, but yeah.
That is what happens when a government ignores currency indexation.
It is an excellent way to visualize it.
Yeah.
If you buy an asset for 100 rupees, and 10 years later you sell it for 200 rupees, you might look like you made a 100 rupee profit.
On paper, yeah.
Right. But if inflation over that decade means that 200 rupees buys exactly the same amount of groceries as 100 rupees did 10 years ago, your real profit is zero.
Exactly zero.
Indexation is the economic tool that adjusts your purchase price to account for that inflation. So if a finance ministry refuses to acknowledge indexation, they're basically taxing an illusion.
Wow.
They are taxing inflation itself.
That's wild. And the text also asks if the finance ministry has any understanding of quote-unquote moratoriums.
Yeah, that's another big one.
Let's clarify what a moratorium actually does in a market context, because the author uses it as another big example of incompetence.
Sure. A moratorium is essentially a government-mandated freeze or delay on debt repayment. So during a crisis, a government might tell companies, hey, you don't have to pay back your bank loans for 6 months.
Which domestically looks like great relief. People love that.
Of course. But to a foreign investor, a sudden moratorium means your counterparty risk just exploded. Your money, or the returns you were expecting from a local partner, are suddenly trapped by a government decree.
Just locked up.
Yeah. Again, it is an unpredictable variable that completely destroys financial modeling.
Which leads to what I think is the most striking, just punch-in-the-gut phrase in the entire piece.
Oh, the harvester comment.
Yes. Because of these retrospective taxes, the lack of indexation, and the unpredictable moratoriums, the author states that India is not functioning as a tax haven, but rather as a tax harvester.
Tax harvester. It is such a profound shift in terminology.
It really is. A haven implies a place of refuge, right? A jurisdiction that actively cultivates and protects capital to encourage growth, like a garden.
Exactly. But a harvester implies a machine built solely for extraction.
Just ripping things out of the ground.
Right. It shows up to reap without sowing. It chops down the crops without nurturing the soil that created them in the first place.
So what does this all mean for the everyday person? Because the author makes a really critical pivot here, right?
They do. They emphasize that this tax harvester mentality doesn't just hurt foreign billionaires or massive institutional funds.
Right.
This arrogance acts as a direct curse on the hard-working domestic middle class.
The collateral damage of these policies falls heavily on local citizens who just trusted the system.
Yeah, and the author deliberately contrasts the complex, punitive burden placed on investment with the shocking lack of basic market awareness from the political system.
They actually bring housewives into this, don't they?
Yes. They argue that ordinary housewives could make faster, better, and more sound economic decisions than the current finance ministry.
That is quite the insult. Why do you think the author uses that specific comparison?
Well, because managing a household budget, requires a brutal adherence to reality.
Very true.
A household budget accounts for actual, real-world inflation when buying groceries. It accounts for immediate cash flow and the absolute necessity of saving for future shocks.
You can't just ignore inflation when you're buying milk.
Exactly. The author is contrasting the grounded, reality-based economic decisions of everyday citizens with a finance ministry that they portray as completely detached.
Right. Living in a world of theoretical patriotism while ignoring the actual physics of how profits and stability are generated.
Exactly.
So you have a compromised regulatory referee, you've got unpredictable tax harvesting, the domestic middle class is hurting, and 4 trillion rupees are walking out the door.
It's a bleak picture.
But the government couldn't just sit there while the house burned down, right? How did they try to stop the bleeding?
Well, they eventually had to react to the market pain, obviously.
Yeah.
But the author views these recent interventions as utterly futile. Yeah. The text uses incredibly vivid Telugu idioms to describe the government's delayed attempts to fix the mess, painting a picture of just desperate, frantic backpedaling.
The language here is super uniquely fatalistic. The author accuses the ministry of being late latifs,
Right.
which is a term for chronic latecomers who are perpetually behind schedule.
Yep. They describe policymakers basically waking up from a deep sleep, realizing the capital is gone, and then scrambling to enact favorable rules.
But it's too late.
Way too late. The author captures the economic tragedy of timing perfectly with a really visceral metaphor.
The biryani one.
Yes. They compare these late policy decisions to offering biryani to a dead person,
Oh, wow.
pointing out that the government didn't even offer them a biscuit while they were alive.
That is brutal. But think about the mechanics of that. You starved the market of good policy, transparency, and fairness when it was vibrant and pleading for it. And now that the capital has actively relocated to other emerging markets places that offer better stability, you serve up this grand feast of policy tweaks and expect the money to magically wake up in return.
Right. But capital allocation is incredibly sticky.
Sticky.
Yeah. When an institutional investor decides to pull $1 billion out of one country, they don't just shove it in a mattress.
Right, they put it somewhere else.
They reallocate it to Vietnam or Mexico or elsewhere. To get that money back, you don't just have to fix your own problems.
You have to convince them to break those new investments.
Exactly. You have to convince them to break their new stable investments and take a huge risk on you again.
And the author takes the metaphors even further. They describe the ministry's recent market interventions, these desperate attempts to lure money back, as having Karthika Vanapojanalu.
Which are traditional festive community picnics.
Right, but having those picnics in a graveyard.
Yeah. You are laying out the picnic blanket, playing festive music and celebrating your new policies, but you are sitting among the tombstones of the investor trust that has already died.
Wow.
And the capital that has already left. Furthermore, the author explicitly states that whatever recent decision the government has made, it is, quote, not a silver bullet to kill a vampire.
The imagery here is just incredible. Graveyard picnics, silver bullets, offering biryani to a corpse. It really speaks to a deep underlying pessimism about the future.
Oh, completely.
Based on the text, do they see any path back to stability, or is that 4 lakh crore essentially gone for good?
The author is resolutely pessimistic about any short-term recovery. They concede that these late, desperate actions, these graveyard picnics, might cause the market to rise artificially for 2 or 3 days.
What traders would call a dead cat bounce.
Right.
Just a temporary recovery in a prolonged decline.
Precisely. The author concludes that the massive foreign liquidity that fled will not return just based on a few frantic policy reversals. The structural damage is simply too deep. The trust is broken.
The text highlights a severe ongoing mismatch between the political system's priorities, which the author sees as focused on cronyism and patriotic optics, and the actual economic drivers of global capital, which require absolute stability and fairness.
Right.
That mismatch has broken the mechanism of trust.
Well, we have covered a tremendous amount of ground navigating this source material today.
We really have.
We started with the intense allegations of a crisis of leadership at SEBI, examining how perceived cronyism and conflicts of interest regarding massive conglomerates like Adani and Blackstone can just shatter the foundational trust of a regulatory body.
Yeah, and then we explored how the illusion of domestic control was dismantled by the reality of global capital.
The divine being's delusion.
Exactly. We looked at the mechanics of why FPIs and FIIs leave. They aren't bound by domestic patriotic narratives. They look for a fair, predictable game. And finding none 4 trillion rupees exited the market. And we unpacked the systemic policy failures that drove that exodus, right? The heavy reliance on oil, the terrifying unpredictability of retrospective taxes, the use of moratoriums that trap capital, and the refusal to acknowledge currency indexation.
Which is taxing inflation.
Exactly. All of which built the author's argument that the government is operating as a tax harvester, punishing foreign funds and the local middle class alike.
And finally, we dissected the author's brutal assessment of the government's desperately late reactions.
The graveyard picnics.
And the biryani offered too late. These metaphors serve to highlight a critical economic reality. Trust, once broken on a massive structural scale, does not easily return just because a government finally decides to change the rules back.
Right. As we wrap up, it's worth reiterating that today's deep dive was an exploration of Anil Aks's highly critical perspective.
Yes.
We presented the mechanics behind these arguments to inform you, the listener, of the intense, very real debates occurring right now regarding the trajectory of India's economic policies.
We aren't here to validate the graveyard picnic theory.
No, absolutely not. But it is vital to understand the economic friction that drives critics to use such strong, desperate language.
Understanding the mechanics behind the anger is essential. And I want to leave you with a final thought to consider, building on the source material we've discussed today.
Let's hear it.
This text relies heavily on the fundamental truth that global capital is entirely, ruthlessly unsentimental.
It doesn't care about your feelings.
No, it does not care about a nation's internal political narratives. It operates purely on the math of competence, transparency, and risk-adjusted returns.
So for you listening, as you watch the global economy shift and observe how different nations compete for these massive pools of institutional wealth, consider the fragility of reputation.
It's so fragile.
Right. In an era of immense global uncertainty where capital is already incredibly skittish, how quickly can a nation's hard-won economic reputation be dismantled by just a few opaque regulatory decisions?
So quickly.
And more importantly, once that trust packs its bags, reallocates its resources, and leaves the borders, what does it actually take to invite it back in?
That's the billion-dollar question, or rather, the trillion-rupee question.
Exactly. Because as we've learned today, offering a feast to a market you've already starved might be the most tragic miscalculation of all.